What happens when the big bear market comes? And more importantly, how will investors react during difficult times in the markets when our hard-earned investments have plummeted? Let's talk about the relationship between bear markets and investors. Welcome to another episode of Money Matters. It's the big one, the big scary one. What do? Jump ship immediately or wait it out? Are you a good market timer? As counterintuitive as it seems, market risk is least when market sentiment is at its lowest, because markets price it in and it's at its lowest point when fear and uncertainty is at its greatest. No one can perfectly time the bottom of a bear market, nor can they time the bottom of a crash. And the same goes for corrections. Someone who says they can is either lying to you or deluding themselves. As painful as suffering a big bear is, you don't want to miss the start of a new bull market. New market returns happen fast and sudden, quickly erasing the downside volatility that happened before it. The upside following a downturn is almost certainly greater. Take the crash during the depths of the pandemic in March 2020. The S&P 500 took 32 days to fall nearly 34%, but then took 148 days to recover and keeps on going. The Hang Seng Index took 66 days to fall over 25%, but then took 303 days to recover. The Nasdaq Composite took 34 days to fall over 30%, but then took 78 days to recover. Finally, as a measure of world markets, the MSCI All Country World Index took 41 days to fall nearly 34%, but then took 157 days to recover and continues to rise in strong form thereafter. You can go back and do your own research during other market downturns, such as the global financial crisis of 2007, and you will find similar characteristics. Think of a bear market like a depressed spring. The more you push down, the bigger the rebound. This is also why I'm not a fan of stop losses. Contrary to their objective of stopping losses, stop losses make you exit the market at the wrong time. You miss out on the rebound. It turns a paper loss into a real loss. In a bull following a bear, the first year of a bull doubles the gains of an average bull market year, and almost half of those first year gains usually come in the first 3 months. The crazy thing is, on the flip side, investors worry about entering the market when things are going well. They say things like, markets are at an all-time high, it must be ready for a crash, or something similar. It's normal for markets to break new highs. Just see my video on why markets always eventually keep rising. Or just type in S&P 500 into your search bar and look at its long historical chart. Got something against the US markets? Then ensure you have a globally diversified portfolio. Still worried? Then you've clearly got a dim view of the future of the human race, in which case no one can help you. Uncertainty is an investor's friend. Uncertainty offers opportunity to find bargains. We like worriers, we like short-termists, we like negative market sentiment, because as medium to long-term investors with one eye on the present and one eye on the future, we can take advantage of assets which are undervalued and have a good future ahead. As Sir John Templeton once quoted, bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Which is why most investors fail to make gains, because they buy at the wrong time when market sentiment is at its highest and market prices are peaking, and then sell at the wrong time when markets are depressed and prices are at their lowest. Uncertainty is an investor's friend. In today's digital world, the near instant free flow of information is fantastic, but not so for investors. It evokes fear and short-termism and turns investors into speculators. There's a real disparity between the financial headlines and what is actually happening in the markets. Just reading the headlines will certainly distort an investor's view of the markets, and it's been taken out of context. Also note that headlines are intentionally attention-grabbing. They can often be exaggerated or even be accused of scaremongering. Furthermore, what makes that article totally true? And what does true even mean? Even factual information such as statistics can be presented in a way to express the individual's opinion. What makes their opinion right? It's just one person's opinion. Lest we forget, these days everyone is supposedly an expert. The general public are sharing their views on social media and many other platforms. Just like a wildfire raging in the forest, fake news or incorrect information can spread across the world in no time at all. And the herding effect means that everyone just takes the news as gospel without question or doing their own research. This herd mentality is crazy. Be careful not to get carried away by the current. It's not easy investing in the markets for most investors. We simply are not programmed in a way that is conducive to making the most of financial market investments. The fight or flight impulse is simply too strong for most people to control and is also proof that they don't really understand their own investment decisions. Conviction in a pick should not falter simply due to some downwards volatility. There's a ton of historical data that shows that investments generally perform. It's the investor that is usually the problem. Peter Lynch is one of the most successful and well-known investors of all time. Lynch is the legendary former manager of the Magellan Fund at Fidelity. He took over the fund at age 33 and managed it for 13 years. In that time, he averaged an annual return of 29.2%. More than twice what the S&P 500 index earned during that time. However, the average investor in the fund actually lost money during Peter Lynch's tenure. According to Fidelity, investors would pull their money out of the fund during periods of poor performance and put it in during good periods, effectively buying high and selling low. It's hard to keep a cool head. The constant bombardment of financial news is conditioning our brains to make errors in judgment. One of the most dangerous pieces of information are stock or investment recommendations that are published online to the general public. Investments are time sensitive and are personal to the individual. Therefore, by the time you see the information, it may no longer be suitable. Additionally, who's to say that recommendation is relevant to you and fits your portfolio? Even copying our investment gurus is not usually a good idea. They may have very different investment objectives compared with ours. Take Warren Buffett, for example, probably one of my favorite investors of all time. One of his famous quotes is, "Our favorite holding period is forever." Whilst I very much agree with his quote, many self-executing investors hold their investments for a very short period of time. A retail investor study by the Investor Education Center showed that Hong Kong investors tend to be quite active in stock trading, with an average investment holding of less than half a year. This shows that investors are attempting to time the market, as half a year is not enough time for a company to thrive or fail. It is not enough time to allow an investment thesis to play out. Hong Kong investors hold blue chips for longer, an average of 3.3 years. But then the survey also shows that 1/5 of investors sold new IPOs on their very first trading day, again suggesting that investors are attempting to time the market. I'll challenge any retail investor to beat a buy and hold strategy using a globally diversified portfolio. I'll be surprised if more than 1% can outpace the buy and hold strategy. Overall, remember that markets always eventually continue to rise. You can bank on it. You can see my video on this by clicking on the link. Therefore, if you can afford the time, you can expect net returns from high single-digit to low double-digit percentages annually, just by tracking the global markets. Sure, you can employ some tactility by building a high conviction portfolio that buys into certain sectors and certain regions, it is easy to see the mega trends in cloud computing, technology and 5G, artificial intelligence, clean energy, to name but a few. But still, we are not timing in and out of the market. Building a tactical portfolio means we are focused on particular sectors and regions and omitting others that we think will only produce mediocre returns. This allows us to outperform a standard globally diversified portfolio that tracks the global markets. We understand what we've bought and why we've bought it, and we do not sell out when markets are suffering huge negative volatility. They are called high conviction portfolios for a reason. Let the traders, the short-termists and the short-sighted play the markets. After all, we need liquidity in the markets for them to function. We investors can sit back, watch the long-term trend head upwards and reap the rewards later when we actually need the funds. The global financial crisis and the global pandemic are not selling opportunities, they are buying opportunities. And those who faced their fear of buying when others were selling are sitting pretty today. Hell, it didn't really matter what you bought. Even a baby randomly picking a selection of stocks will be up, and up big. So, get involved, face your fears, don't follow the crowd, and sit tight. Investing is much easier than we make it out to be. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you liked the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.